candlesticks is what you guys will be learning, right? So the reason you need to learn candlesticks second is because candlesticks are the base of your trading. They're going to be the most important part. Let me turn off my phone because these guys don't understand. But anyways, the Japanese began using candlestick analysis to trade rice in the 17th century. While this early version of technical analysis was different from the US version initiated by Charles Dow around 1900, many of the guiding principles were very similar. The what price action is more important than the why. All known information is reflected in the price. Buyers and sellers move the market based on expectations and emotions, fear and greed. Markets fluctuate. The actual price may not reflect the underlying value. So let's go over how to read whether a candlestick is bearish or bullish. So in order for a candlestick to be bearish, the closing price must be higher than the opening price. So every candlestick you see will be represented by the time frame within that chart, right? So if we're looking at the 5-minute chart, every candlestick you see on there will represent 5 minutes. If it's the 1-hour chart, every candlestick will represent 1-hour increments. So anyways, what this is saying, if we're on a 5-minute chart, this is saying within 5 minutes, it opened here, went as low as here, went as high as here, and closed here. So in result, it looks like this. So remember, one more time, if it is 1 o'clock, at 1 o'clock, it opened here, and then all right, at 1 o'clock, it opened here, went as low as here, went as high as here, and closed here. And then for here, in order for it to be a bearish candlestick, yeah, hold on, because somebody keep calling my phone, and I got my iPad connected to it. People need to be more considerate. But anyways, so this is how you tell whether a candlestick is bearish. The open, so the close must be lower than the opening price. So if I was to look at this, it opened here, went as high as here, went as low as here, and closed here. So that is how you tell whether it's red or green candlestick. If it's a green candlestick, then the close will be higher than the open. If it's a red candlestick, then the close will be lower than the open. Compared to traditional bar charts, many traders consider candlestick charts more visibly appealing and easier to interpret. Each candlestick provides a simple, visually appealing picture of price action. A trader can instantly compare the relationship between the open, close, as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. So this is how you can tell whether it's a long green or red candlestick. Like I said, can you guys hear me, by the way? You guys can hear me? Okay, so you guys can. In order for it to be a long green candlestick, remember these represent strong buying pressure. The longer the green candlestick is, the further from the close is above the open. So remember, if it's a long green candlestick, the further the close is above the opening price. And if it's a long red candlestick, the further the close is from the opening price. So that is how you tell whether it's buying pressure or selling pressure. But in reality, volume really tells you the pressure of the candlestick, because sometimes stocks can move on low volume but have a green candlestick with low volume. So you need to pay attention to volume more so than anything when it comes to pressure. But 9 times out of 10, if it's a big green candlestick, it'll have nice volume to back it up with. So let's go over longer upper wicks and longer shorter wicks, right? So below. So long upper shadows indicate Oh, by the way, shadows and wicks are the same thing. So if someone says shadow or wick, so this right here will be your shadow or a wick. Depends on who's talking. So long upper shadow indicates that buyers were in control by pushing the prices high, but sellers came back in control to push the prices back down. This is seen as a bearish sign. So basically what this is saying is it opened here, and then it went as high as here. So bulls were in control. So this was once a green candlestick because it opened here, went as high as here, went as low as here, and closed here. So that indicates selling pressure. And then for the long lower shadow, that indicates sellers were in control by pushing the prices low, but buyers came back in control to push the prices back up. This is seen as a bullish sign. So as you can see, this is another good psychology. So it would have opened here, then it would have went as low as here, and then it would have went as high as here, but closed here. Does everyone understand how candlesticks are formed? Put a yes if you do. Okay, so that's pretty simple. Someone said no. Most people said yes. I will show on the chart again, but you know, so let's go over it. So let me give you guys a clear example. So this is on a 5-minute time frame. This is QQQ, and we're going to talk about, and remember, shadows equal reversals. So before I even start this, if you see a shadow or a long wick, it means a reversal of some sort, always. So always remember that part of the game. And always remember, represents, keep saying remember, too many R's. It always represents a reversal. So let's go over the 5-minute time frame, and we're going to translate it into the daily time frame. So right here is after hours and pre-market. I am on the Trading View app, and I'm looking at QQQ. So this is pre-market, and this is after hours. So it would have opened here, and then buyers pushed the price up, so prices went up. And then sellers took control, and then it closed here. So how does that look? If I was to take my pen and draw out how it looked, so I would have saw that prices opened there, and then it went as high as here, and then sellers came back in control to push the prices back down, but then it closed somewhere near here. So if I was to fill that in, that would be my candlestick. So basically, that is how you're looking at it, and it looks similar to this right here because I'm looking at the chart based on how it opened, closed, the highest and the lowest point. So what candlesticks show is your open, close, and high all in one. So it gives you a clear visual representation of the overall, price action of what happened. It gives you a clear indication of what happened. So if I'm looking here by this, by seeing this, I will know during the day there was some type of reversal. So today was pretty good, but then bears came back in control and pushed the prices down. And one more time, remember it opened here, and then buyers pushed the prices as high as here. So this will explain the wick, right? This will explain the wick. And remember, so this is your opening price. So this is your opening price, right? And this is your opening price, right? So that's step one. And this part is how high it went. So it went high here. So this wick represents that part. And then sellers came in control and pushed the prices lower than the opening price, right? So when the sellers came back in control and pushed the prices down lower than the opening price, it went somewhere right there, but as low as here. So that kind of shows what's going on. And remember, this is the 5-minute time frame translated into a full day. So from here to here is a full day. Here to here is a full day. Does everyone understand that? Okay, good, deep, in-depth explanation of a candlestick. So candlesticks with long upper shadows, long lower shadow, and a small real body are called spinning tops. Even though the session opened and closed with little change, price moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand. The result was a standoff. So how do we look at this spinning top? So like he said, neither buyers nor sellers could gain the upper hand, so the result was a standoff. So how do we know this? So it would have opened here when as low as here, when as high as here, but close here. And same here. Open here when as high as here, when as low as here, but close here. So they call that a spinning top. And what that does is shows a slowing of momentum because it represents indecisiveness. So remember, candlesticks are all about psychology. Always all about psychology. So what is the psychology of having a downtrend and then next thing you know, you see a sign of indecisiveness at the bottom? That could represent a reversal. And same thing if you had an uptrend and then you see a spinning top, and you can indicate that, okay, bulls have ran out of steam because there's no more buying pressure. So let me watch out for a reversal. Now, doji candlesticks. Dojis form when a candlestick open and close are virtually the same. The length of the upper and lower shadow can vary, with the resulting candlestick looking like a cross, inverted cross, or plus sign. Alone, dojis are neutral patterns. Any bullish or bearish bias is based on preceding price action and future confirmation. So basically, what dojis are when the open and closing price are virtually the same, right? So we would have known it would have opened here when as low as here, when as high as here, close here. And same here, it would have opened here when as low as here, but close here. So this one, in my opinion, could be, I mean, they're kind of neutral, but you could use this as a bullish pin bar because buyers came back in control from a defeat. You know, they were defeated, came back in control, and end up closing near the opening price. And same here, this was at an uptrend. So let's just say, let me get out my pen. So this would be better off if it was a downtrend, right? So this one would be a downtrend. Next thing you know, you see this, and then you see sellers come in and push the prices down, but then bring it right back up to a T. So to me, that's a win for the buyers. And over here, this would be a L for the buyers because next thing you know, bulls push the prices up, but bears came and push the prices right back down. So that tells me that, you know, that's a big reversal. So that's an L in my opinion. But they're named pretty well: Dragonfly, Gravestone Doji. So, and then you have your long leg doji, which is essentially the same as the doji, but with longer highs and lows. So here we have the candlestick patterns, and I want to know which ones are high probability. I only use 3 of these that I consider high probability setups. So here are the ones that I believe personally are high probability setups. I believe in the hammer, which is the pin bar. I believe in the Harami pattern. Anything Harami, anything hammer, and anything engulfing are my favorites. These are my favorites, those 3. So these are my top 3. And I will explain why. So, So here we have what is called a pin bar. Now, why is it called a pin bar and not a hammer? The reason you will see pin bar being used frequently is because in order to qualify as a hammer or a shooting star, the stock has to close at the high. So very rarely will stocks close at the high right here or close at the low. So therefore, they will have wicks at the end, but they will still look like a lollipop. So that is why we call them pin bars instead of hammer, because it's technically not a hammer if it has a wick above the high, or the close, or a wick below the close. So but this right here is the highest probability candlestick pattern in the game. No questions asked. This is it. And the time frame you will be using it on is mainly the daily chart, 4 hour or 1 hour, but I personally use it on the daily chart only because I trust the daily chart. I can't trust the 4 hour when I've seen what the daily chart can do. So anyways, here's your 1 day chart, and this is Costco, which I've still never been in a Costco. So I've seen it, the stores have just never been in it. Would like to go in. But anyways, so here we have something called a pin bar, and let's explain the psychology of the pin bar. So here we have an uptrend, and then we have a retracement. And then next thing you know, we have a pin bar, and look at the result of the pin bar. It took off like a rocket. And why is that? It's because of psychology. Remember, these candlesticks tell market psychology. So what is the psychology behind this candlestick? What you have to do is you have to look at this candlestick as if you fell to like the bottom, and then you bend your knees, and then you jump as high as you can to the moon. Like, that's how I kind of look at a pin bar. Basically, someone, bend down as low as they could and jump as high as they can from support. These classes will be recorded, so I can't just be doing stuff for like just one person in the middle of a class. But forget it. Just screenshot. Where is it? Screenshot this. Don't forget it. All right. Please move along with us because I won't be going back. So anyways, Dollar General did the same thing. It went down, and then you see the pin bar, and it took off like a rocket. And here's your stop loss. Your stop loss is always below the pattern. So you wouldn't have got out of this trade right here. Well, technically, I would have got out somewhere right here because before earnings, but it ran down their earnings and then just kept going because pin bars are very powerful. And you can see a pin bar right here too. You see this, and then it fell to some support and then bounced. And you don't want to do pin bars. Like, which pin bar wouldn't I play? Like a pin bar right here in the middle of something. It doesn't count unless it's at some form of support. So as you can see, this has a form of support and this has a form of support. It needs something to bounce off of in order to be considered a pin bar. Like, you can look at all the forms of support and all the bounces here. See how that one has something to bounce off of and then something to bounce right here. Support means, and support and resistance we'll go over, but basically Mike will go over in next class. But it means support is your floor, resistance is your ceiling. So this would be resistance, and then, and this would be support. Just like if you were building a house, you have to build your support beams, right? So support is always considered something to hold something up. Resistance is something to hold something back. Pretty much your ceiling. You feel me? Does everyone understand that explanation? Just that brief explanation. Okay, cool. So anyways, here is your bullish engulfing patterns. And to make a long story short, bullish engulfings are very powerful. They are your second high probability trade. In my opinion, they are very, very, very powerful. They're just as powerful as pin bars, but pin bars got a little bit more oomph to them, I'll admit, because, it's a big reversal on that candle. So here you have a bullish engulfing pattern. And in order to qualify as a bullish engulfing pattern, it has to engulf the body. So don't worry about, so remember, this is your body, the open and close price. The open and close price is the relationship between the open and close is your body. The highest and lowest points don't matter. So this is an engulfing and this is an engulfing. And basically what that is saying is bulls took over the entire mood and the bears took over the entire mood. There will be a reversal. So here we have CRM, and let's look at the results of an engulfing pattern. So here we have CRM, we have an engulfing at support. So remember what I said about those supports. See what I'm saying? You need something to fall back on. Where else is a support? You know what I'm saying? You need something to fall back on. But here we have a nice little support zone right here, right? And then we have a bullish engulfing bouncing right off it, right? So basically we have a bullish engulfing, and what you would do is you would enter 15 cents above, but I think I'll go over that later in the class. So we have a bullish engulfing at support, and look at the results of it. And then we have another one here. So we have two support bounces, virtually the same thing. Boom, boom. See what I'm saying? So the third strategy I want to teach you guys is the bearish Harami, but you know how I said pin bars are still called hammers? Inside days are still called Haramis. And Harami means pregnant in Japanese. So that's the reason this is called a Harami pattern. So Harami here is here. So basically what it says is there's a downtrend, and then next thing you know, I guess she gets pregnant and, you know, she reverses. And same here. There's an uptrend, and then there's a slowing of momentum. She gets pregnant, and then she spits out a baby. So that's how I kind of look at it with Harami. Like, I'll never forget it. Like, you know, it stands for pregnant in Japanese, and I kind of get why. But it's funny because if it's on this side, this would be an engulfing, and same here. So if it's on the right side, it's a Harami. If it's on the other side, it's an engulfing. Does everyone kind of get that? Okay, so there you go. And then here, what do we have? We have Microsoft. So we have an uptrend, and next thing you know, we have a downtrend. And then what do we have here? A slowing of momentum, an inside day, or a Harami pattern. Microsoft gets pregnant, Bill Gates has a baby, and he shoots for the stars. So anyways, let's go over entry points. Like I said, you will enter 15 cents above the high. So you cannot, Bill Gates does own Microsoft, right? If I'm not tripping. Yeah, he does. Anyways, the black lines are your entry points, and it represents 15 cents above the highs. So this is on the daily chart. Remember, I said I usually trade candlestick formations from daily charts. So here we have an engulfing pattern. Your entry point will be here, 15 cents above the high, 15 cents above the high, 15 cents above the high. See what I'm saying? It's always going to be that way. It's always going to be that way. You see what I'm saying? So screenshot that. Those are your entry points for candlestick patterns. And then here we have the entry points for if you were to buy puts for candlesticks. So 15 cents below the low, 15 cents below the low, 15 cents below the low, 15 cents below the low. Same thing on each one, right? Same entry on each point. And yes, that's just how I do it on the daily. I don't trade candlestick formations on any other chart but the daily. Other than that, I'm going with straight price action. I'm just going to be completely honest with you guys. That's just how I trade. Now, you, on the other hand, like I said, throughout this course, you might develop your own strategies. But more than likely, you're going to use the strategies from, later on in the course that I teach. So here we have a bullish pin bar. And like I said, I'm going to let you guys on a little secret. You don't, believe it or not, if it doesn't break out this day, it can break out the third day. So you always want to keep into account. And sometimes you need to set alerts. So if you set an alert 15 cents above the high and it would have broke, you could have got in on that third day. Now, granted, it could break out the next day because that does happen. Let's see if we see a pin bar on here. Nah, we don't see a breakout pin bar here. But it can happen on the second day, but if it doesn't, it'll be the third day. And then here, like I said, Shopify, we have a bullish engulfing pattern at the support, and then we enter 15 cents above the high, and it goes. So key takeaways: candlestick charts display the high, low, open, and closing price of a security for a specific period. Candlesticks originated from Japanese rice merchants and traders to track market prices and daily momentums hundreds of years ago before popularized by the United States. Candlesticks can be used by traders looking for chart patterns. So I hope you guys enjoyed this brief candlestick class, and we're going to pass it off to Mike.
All right, guys, welcome to day 2, AMU University. Before I get started, I just want to make sure you guys can hear me and see my screen. Perfect. Well, I am live from Miami, and today I'm going to be talking about support and resistance, which is a very important foundation that everyone must have, a broad knowledge for on the subject. So support and resistance. Think of support like standing on a layer of thin ice on a pond that just froze over. You can tap it a few times with your feet before it finally gives in and you fall through. Support, also called demand, is what prevents the stock from falling. The support layer, or buyers, holds the stock from breaking below a certain level. If the level is tapped enough times, buyers begin to step down and the stock collapses through the ice or support. Think of resistance like a volcano. There's a buildup of lava and smoke hidden below a large layer of rock, ready to explode with just the right amount of pressure. Resistance, also called supply, is what prevents a stock from rising. The resistance layer, or sellers, prevents the stock from breaking above a certain level. If the level is pressured enough, like the smoke from a volcano, sellers begin to step down and the stock bursts upward. So identifying support and resistance. I recommend you start from high time frames, so like the weekly or the daily, and then work your way down all the way, from the 1 hour down to the 5 minute. Support and resistance levels can be seen on charts from the 1 month all the way down to the 1 minute. It's also important to start from a higher time frame and work your way down so you don't miss any big important levels. Usually the biggest levels will be on the highest time frames. So on the daily, I use the hourly primarily, but on the daily and the weekly, you can see some very large support and resistance levels. And, unlike, contrary to most people's beliefs, support and resistance do not have to be at exact price levels. So it doesn't have to be all the support at 210. It could be some at 210.50, some at 210, some at 210.25, and then you just call it a support zone. or a resistance zone. So after, this is a rule, after current resistance is broken, it has now become a new support. So if Apple has a resistance at 150 and it breaks 150, then that old resistance is now your new support. After current support is broken, it has now become a new resistance. So if Apple has support at 150, it breaks down through 150, then that old 150 is now your new resistance. Personally, for day trading, I like to start with the 1 hour chart and work my way from there to the 15-minute chart and then to the 5-minute chart. Comparing each time frame gives you a bigger picture on the final outcome. One rule of thumb that I've learned over the years is that the more time a stock touches a support resistance, the stronger that level becomes. For example, if Apple touches 210 5 separate times and bounces off each time, that is way stronger than if it only touches 210 twice and bounces. The stronger the support resistance level, the larger the implied move after the breakthrough. So I have a lot of examples because the best way to show support and resistance is really to actually show you guys charts. So these examples, they're not super recent. I mean, they're from a couple months ago, but it really doesn't matter. You just have to see what they look like on the chart. So this was a weekly support for Amazon. You can see it bounced off of it twice. And if it bounces off of the level twice on the weekly, then that is a pretty big support or resistance. So you can also see, back in early, looks like April, maybe March, it bounced off of 2200 on the resistance side. So that became a resistance and it finally broke through that. And now it made this 2250 the support. So that's from May. It bounced off of 2250 twice, and that was the support. Weekly support for Walmart. So you can see if you go back and look just before 2020, the dates are down at the bottom, by the way. So if you're looking like October, that 121 was actually a resistance. So back before 2020, late 2019, 121 was a big resistance for Walmart. It couldn't pass through it. It wicked through it one day, but then it got shot back down and actually closed the day below again. Same thing right here. It wicked through that 121 in late 2019, but then it got pushed back below it. So like I said in the previous slide, once a stock breaks a resistance, it then becomes a new support. So you can see when it finally broke through 121 here in April, it cleared 121, that resistance. So it cleared it, it closed above it. And then when it actually closed above it, it came back down, right? And then bounced off of it. So that old resistance is now new support. And you can see it's bounced off of it 4 times now. And this was in April or May. So bounced off it 4 times. That's a beautiful weekly support for Walmart. Daily support for Amazon, it's that same level that I showed you on the weekly, the 2250, but you can just see, it really bounced off it nicely. So if Amazon did clear 2250, then it would probably go back down to this previous resistance over here from February. It bounced off of 2200 about 3 times on the daily here. So that's a nice resistance there. And this is, a double bounce there on the daily. So that's a nice level, 2250. Daily support, it's the same thing. I showed you the weekly chart. This is just breaking it down. Like I said, I like to go from higher time frames to lower time frames to just get all of the information, all the details, and see what it looks like on each chart. But you can see here as well that Walmart bounced off of 121, starting in May, 1, 2, 3, 4 times. So that's a really nice little support zone right there on the daily for Walmart. Daily support for IBM. I mean, this is just very clear. It actually pen barred twice off of that 112. So that, these are very strong rejections of that 112 level. This is also called a double bottom. So if it breaks through that 112, then you could assume that the stock will go down. This is the daily support. So daily support for PayPal. I mean, this one's just super clear. It gapped up. This is from earnings, gapped up all the way from about 127, 128, gapped all the way to 140. And then it pushed through. The day after earnings, it pushed, made a really nice candle, about a $6 candle for the day, came back down. 4 days later, hit that 140 again, bounced off of it again. About a week, 2 weeks later, came back down, hit that 140, pen barred off of 140, and rocketed. So this is a beautiful, beautiful support here on PayPal at the 140 level, as well as a nice gap right there from 130 to 140 due to the earnings. And then breaking it down. So I start with the high and then I go to the low. So now looking at support examples from low time frames. This is just an intraday. When I'm looking to day trade support and resistance levels, then this is just something that I saw, at the 132 level and beyond. This is the 15-minute chart. And you can just see it kind of rejected that level, 2 of these candles in the morning. So that's good enough for me. If it clears that 132, then I'll be looking to scalp that short. Same thing here. So Tesla bounced off. This was back in June, you can see. So just a couple months ago, it came down and bounced off that 870 really, really hard. So that, I really like to see that. I want to see hard rejections of a certain price point. And even though it didn't have a lot of rejections, like it didn't come back down in the afternoon and hit that 870 again, it did reject off of that level nicely. So I would be considering a scalp if it loses 870. And then breaking it down all the way. So like I said, you start with the weekly, then you go to the daily, hourly, 15-minute, 5-minute to see all of the details. But this is the 5-minute support now for Visa. You can see in the morning around 11 a.m. it hit that 195, bounced off of 195, and then came back in the afternoon and bounced off that 195 4 more times on the 5-minute candles within just 20 minutes right here. So that 195 was a very clear support for me. And then you have 2 options when you're trading support and resistance. You can either, the next day, if it goes down and touches that 195, you could either buy calls or long the stock when it gets to 195 to play the bounce, or you can wait for it to flush that level, and then you would play puts or short the stock. And then 5-minute for Walmart. Like I said, it doesn't have to be at a specific price point. It just can be a zone. But this is a very, very, very clear support zone for Walmart. I mean, it just kept coming down all day long, trying to break that level, but it couldn't. There were a lot of buyers at the 123. Like 122.80 all the way to 123. Just a lot of buyers holding up that level. So it never got through. But that is a very clear intraday support for Walmart. And then resistance examples from high time frames. So this was the weekly resistance for Apple. I mean, it absolutely cleared that out of the water in July. It ran up a ton, but you can see here that it rejected off of that same, it was about 328, but it rejected off of that twice. So that became a very strong weekly resistance. Weekly resistance for JP Morgan. So if you're actually looking back, this is 2019. So this is like June of 2019 and then October of 2019. So you can see that this was the old support for JPM. So it bounced off of 105 perfectly in June, bounced off, and then came back down, wanted to test that level again. We got like a nice 3 weeks. This is the weekly chart. So each one of these candles is literally a week long. And it bounced off of that like 3 or 4 times right here. Came all the way up. Coronavirus happened in March. It finally broke that level. But you can see in April of this year, when it went to go test that 105 level, it then rejected it. So that old support is now that new resistance. So 105 was the new resistance on the weekly. You could have, when it got back to that 105, you could have taken this stock short, or you could have bought puts And then to buy, you wait for it to clear this 105 level. So if you're going to buy calls or long the stock, then you would have to wait for it to clear that 105 resistance. Weekly for Starbucks. So, just got one rejection here in April or May, and then another rejection on this weekly candle in June. So very clear, the 80, it's a whole number. That's a very nice little weekly double rejection right there. And then the daily. So this is the same exact chart from the weekly, but now it's just a zoomed in version. So you can get all of those, more micro levels and compare them to your macro levels, which are those weekly and daily resistances. So just looking at this, you can see, there was a little bit of supply around the 324.50 area, rejected in May right here a couple times, and then back here as well in early 2020 before Corona. You can see it rejected that 324.50, and then the tops of those two candles for the weekly were at around 327.83, 328. So that is the broken down version of what I showed you on the weekly, but this just allows you to go down and actually see, all of the details. Daily resistance for IBM. So this is very clear, like I said, this was support. So 130 level back in late 2019. You can see it rejected it twice here on the daily, 130. Coronavirus happened. It broke through that level, absolutely smashed through that level. And then it came up. What did I say? Remember, what's the rule? After a stock breaks an old support, it's now new resistance. That 130 was support back here in 2019, but then it broke through that because of the coronavirus, came up 130, didn't touch it, but it got very close, and then rejected off of it $20. So that's a very beautiful resistance there on IBM. Daily resistance on JPM. So I showed you guys the chart on the weekly. I mean, that 105 level was super clear. It rejected it so many times back in late 2019. So then when it finally cleared that level this year, 2020, this is like March and April, it came up, hit that 105, rejected, and there you go. There's your beautiful, beautiful resistance there for JPM. And then breaking it down. So like I said, go from high time frames to low time frames and break down so you get all of the details, micro and macro. So there, here you go, 15-minute resistance on Apple. And yes, I do use, when I'm trading intraday, I do use pre-market and after market data for my support and resistance levels. So this is a 15-minute resistance on Apple. You can see 324. It rejected about 4 times in pre-market. So that's definitely something that I'm looking for the next day to take long if it clears that level. 15-minute on Amazon. So you can see it rejected pre-market here at 24.80 on the 2nd. And the next day it also rejected that same exact 24.80 level. So that's all I'm looking for. When it comes to support and resistance, you're just looking, where has it rejected the most? At what price has it rejected the most? And then that will be your point of entry, whether you're taking it short at resistance or you wait for it to break through that resistance and you take it long. 15-minute for BA, 156. Like I said, it doesn't have to touch that level exactly. I mean, it went up to like 155.80, something like that, but it did reject it twice. So that's a really nice level that you would want to be looking for the next day on market open. 5-minute resistance on Facebook. I mean, this is just a very clear intraday resistance. You can see it came up, hit that 229.75, rejected, came up again, 229.75, rejected, up again. So rejected 3 times there on the 5-minute. I mean, it's just intraday. You want to look for scalps when it breaks these levels. But it came up. You got a little bit of volume, not a ton of volume. I mean, there's not usually that much volume at around 2 p.m., but it did come up. It did clear that level. 5-minute resistance for SHOP. Super clear again. I mean, it's just, it rejected it twice right here in the morning, and it's a whole number that's 770. So, you just wait for it to get to that level, and then, you wait for it to clear that level. And look, volume came in, a lot of volume came in. So then it broke through 776, came back down. Remember, like I said, when you have an old resistance and it breaks through it, then that resistance now becomes support. So it broke through it, came back down, hit that 770 again, and bounced off of it. So time frames to focus on. Personally, I use the 1 hour chart to find key supply and demand levels pre-market every single day, so I know where the strongest levels of the past week are. After finding these levels, I then move to the 15-minute or 5-minute intraday charts to get a more real-time view of current price action and intraday levels forming. For swinging, I start by looking at weekly chart, then daily chart, then 4-hour chart. This method of working your way down through time frames allows you to see the big picture, then dial in on more important details. So I showed you guys a lot of examples today, but now I want to show you examples from right now. So what are the levels that I'm currently watching that I could potentially trade even tomorrow? Let's take a look. So I'm switching over to my trading view. I want to see if you guys can see my trading view, yeah? Okay, perfect. So you can see I'm on the Apple chart. I already have the red line marked of the level that I'm looking at. This is the 1 hour. This is trading view. By the way, to add this line for support resistance, it's over here on the left side panel. You're just going to click that little arrow next to this, and you'll click horizontal line. Very easy. And then just place it at whatever level. So I already have placed this level for Apple. I'm looking at the 1 hour. This is the most important chart, in my opinion, to find these key supply and demand levels. So I'm looking at 110.50. It rejected it like crazy, and then also rejected it on after hours. So yeah, 110.50 level for Apple. AMD, I'm watching these two levels. So you got some nice, we got some nice rejections of the 77.5 level. You can see the bottom of this candle from yesterday at 11 a.m. Or not yesterday, Friday, yeah. So the bottom of that candle was at 77.50. That signifies a rejection. And then again, here in pre-market, it actually rejected it twice, and it rejected it on that opening candle. So I like to look, I'm looking at this, and then I go ahead and look at the 15-minute. I can see, okay, wow, yeah. So it rejected that nicely. It also rejected it, you can see here, in pre-market or after hours of today. After hours, yeah. So, that 77.50 looks like a really, really clean level of support on AMD. And then 76 is the next level, which is the bottom of this candle from Friday. Also looking at Amazon, 3,100. This is also a psychological whole number. So a lot of people like to trade around those 3,100, 3,200, 3,300 levels. But you can also see it came down on Friday, got close to 3,100, and then bounced off of it strongly. So I'll be watching that 3,100 level for Amazon this week. Also watching BABA. Oh yeah, this is TradingView. For anyone who doesn't know, this is tradingview.com. I have the premium version, which is $60 a month, I think, something like that. But you can also get like a pro plan, which is pretty good too, and it's cheaper. But also watching BABA, this 266.65 level, it rejected it very nicely on Friday, and then came down in pre-market today and bounced off of it again. And then it bounced off again in after hours. So I'll be definitely watching this 266.5. And then just looking at this chart right now, I can see as well 284 is a really nice macro resistance. If it clears 284, then it should just flow right through that candle up to about 290. And then there's like two more. Netflix, and his levels is kind of far right now are at 508, but I am watching if it does get back to 530, then that looks really nice. I mean, it has a nice resistance zone right there that it kind of has been rejecting off of that last week. So, you know, there's a nice, could potentially run if it breaks that 530 level. And last but not least, NVIDIA. I love NVIDIA. NVIDIA is one of my favorite stocks to trade. And you can see very, very clearly on Friday, it came down, almost touched 465 and then rejected big time. And then again, pre-market rejected big time. And just kind of looking at the different time frames, you can see very, very clearly that yes, 465 is a beautiful support. So if it clears that on volume, then this will be good for puts. 465 NVIDIA. Well, I hope this made sense for today. And now you guys actually have a little watch list for this week. And I'm going to be passing it off to Unraveler now.
Thanks, Mike. Hope you guys can see my screen. Welcome to day 2, AMU University. Today, I'm going to be teaching you guys how to identify stock price trends. So let's get started. So the table of content for today's lesson. First, I'm going to be giving you an introduction on what is a trend, the different types of trends, trend lines, why do we draw trend lines, how to use trend lines, selecting a time frame for trend trading, and then we'll be going over a couple of examples. Okay, let's get started. It's a very interesting topic. Hope you guys learn a lot and take notes. So what is a trend? The general direction of movement of the market or an equity based on where they have been in the past is referred to as a trend. Trends are created based on an equity's price movements conforming one of the main principles of TA, that's technical analysis. Price moves in trends. Now, let's take a look at this chart here on the right side. So just by looking at it, we can clearly say that the general direction of movement of price is up. Stock was trading low here. Slowly it started rallying. It's increasing day by day by day. And eventually it hit a high here, slowly pulled back. Then it started going up again, pulled back again, created a new high, pulled back, and then eventually it created a new high. So despite all these noises here, just by looking at this chart, you can say that what the general direction of trend is. The trend is up, the stock price is moving up. By the way, this is the stock chart of Amazon, so if anyone's wondering. So just by looking at it, you can say what the trend of the chart is, and that is what we call as trend. And a trend is created based on the price movements, based on the past price movements of the stock. So over here, it was low. The new direction, then it created a new high here. So by comparing this low point and this high point, you're able to tell that stock price has moved up. And by comparing this low point here to this point here, you can tell that the stock price has moved up. So by comparing the past prices, you can easily tell if price has either gone up or gone down or just remaining the same in the same area or zone. So that's how you would identify a trend. And one of the main principles of technical analysis is that prices always moves in trends. So no matter what book you read, this line would always be mentioned at some point. Okay. Stock prices do not move in a straight line in any direction, but rather move in a series of swing highs and swing lows. All trends are made up of these swing highs and swing lows, but what are they? So looking at this chart, you can clearly say that price does move up, but it does not move up in a straight line. And you can clearly see that there is it moves in a wave-like structure here. This creates a new high, then there's a pullback, this creates a new high, pullback. So these wave-like structure is what we call a swing highs and swing low, and I'll be going over this in detail. This concept, if you grasp it really well, you will be able to you'll look at stock charts differently starting tomorrow, because many times when beginner traders, they enter a position. So they would buy a breakout stock, and when they see a pullback, they get out. So when they try to exit their position, they cut loss. The thing is that stocks do not move in a straight line. If you know how to set up trends and how to identify swing highs and swing lows, you'll be able to read stock charts better and stay in the trade for a longer period of time. Okay, now let's get started. So what are swing highs and swing lows? So what is a swing high? When price rallies, there comes a point where it loses momentum and hits a natural resistance. So this is a candlestick chart here that you see on the right side. And you can clearly see that price starts here, creates a high, just drops, then creates another high, drops, another high, and then slowly it moves up. So this was the starting point here, and it creates a high over here. But you can clearly see that it does not move in a straight line. And swing high is a point where the resistance also comes into play. So usually when a stock rallies, when does a pullback happen? So you should assume that a stock rallies. So stock's moving up right now. There will come a point where it's going to lose momentum, meaning it does not have enough juice to go any higher. And when that point comes, we'll hit a wall or a resistance area, and the stock will start to pull back. This resistance that's forming here, that is the wall that's getting formed, may be a result of lack of buying in the market or an increase in supply. So what does it mean by lack of buying in the market? So when a stock usually rallies, there will be a lot of buying pressure, and as the demand becomes greater than supply, the stock is going to move up. At some point, there are no more buyers in the market, so everyone's already in the stock, and to go more higher, we need more new buyers coming in, but the buyers are not there anymore. So when that happens, a lot of people will want to be taking profits. There'll be sellers coming in there, and they'll want to try to push the stock price down. So when that happens, that's why we get pullbacks. So when a stock rallies, it hits a wall, there are no more buyers in the market, there are an increase in number of sellers in the market. So when supply is greater than demand, stock prices fall. So when that happens, we get a pullback, and the high point here, that is the area of resistance, is what we call as a swing high. The point of resistance where a rally ends in a trend is called as a swing high. So stock rallies, hit a resistance, the rally ends there, then we get a pullback. That high point is what we call as swing high in a trend. Now, what is a swing low? A swing low is the opposite of a swing high. So when price falls, that is declines, there comes a point where it loses momentum and hits a natural support. So in this case, after price hits this high point, we get a small pullback here, we get a sell-off here. The sellers are in control, they try to push the stock price down. But at some point, the selling will slow down, meaning everyone that wanted to sell and take profit have already done so, and price will approach a point where the buyers become interested again. So that's this point here. The support may be a result of lack of sellers in the market, or there's an increase in demand causing the stock price to reverse. So at some point, the selling slows down and buyers are coming back in again. The bulls are coming back in, wanting to buy the stock and push the stock price high. This support level or this low point where that reversal happens is what we call a swing low in a trend. The point of support where a decline ends in a trend is called a swing low. Now, all trends consist of these swing highs and swing low. So if you see, take this candlestick chart, for example, we have a swing high here, a swing low. The buyers came and bought this dip here, push price back to create a new high. This is another swing high. And then buyers couldn't push prices any higher. Sellers took control again. So we got another pullback to create this swing low here. And then we had another pullback, created another swing low, created a new high, consolidated a little bit and created another new high. But you guys get the point, right? Stock price didn't move in a straight line. We had a price moved in waves. These waves are what we refer to as swing highs and swing lows. Okay, I hope that this concept is clear. So what are the types of trends? So far we've learned that the general direction of movement of a stock, that is stock price, is what we call as a trend. We also learned that trend comprises of swing highs and swing lows, and that it doesn't move in a straight line. Trend moves in wave-like structure. So the high point is what we call the swing high, and the low point is what we call the swing low. So what are the different types of trends? So the ability to identify a market trend is crucial when it comes to trading. So no matter what kind of trader you are, you may be a day trader, you may be a swing trader, you may be an equity trader, whatever kind of trader you are, identifying a market trend is crucial. Market trend, stock trend, whatever your chart you're trading, you need to be able to identify the trend because you want to be trading with the trend and not against it. So there's a very common saying saying that the trend is your friend. The reason that they say that is because no matter what position you take in the market, you want to be trading with the trend. So for example, today, the trend was bearish on most stock. In fact, the trend is bearish for the last couple of days, but people keep buying calls thinking that the market's going to reverse, the market's going to reverse. And for the last 5 days, we've been having this huge price gap down. A good example is Tesla. I kept seeing people trying to buy Tesla, buying the dip on Tesla, and it keeps dipping. The reason is because the trend is bearish. Tesla was 500 5 days back. Now it's close to 300. That's a $200 drop. And people keep trying to buy the small retracement dip instead of trying to short the pop and play the downside move. The primary trend is bearish, so the most profit is available in the downside, not on the upside. So that's something you would have been able to identify if you know how to read a stock chart and how to read price trends. Okay, as a trader, you should know how to identify price trends so that you can trade with the trend and not against it. So what are the different types of trends? So there are 3 types of price trends: an uptrend, downtrend, and a sideways trend. There are only 3 types. Okay, so now let's break these down in the next couple of slides. So what is an uptrend? An uptrend is a bullish move where the stock price gradually rises over a period. Okay, an ideal uptrend is characterized by a series of higher swing highs and higher swing lows. So this is a line chart of an uptrend here. Clearly, you can clearly see that the general direction of movement of the stock is up. So that's why we call it as an uptrend. And previously, I told you guys that all trends consist of swing highs and swing low. In an uptrend, swing highs are known as higher swing highs, and swing lows are known as higher swing lows. So why are they named differently? So the reason is a swing high in an uptrend is called a higher swing high because every swing high is higher than the previous swing high. So look at this. So here we have a swing high here and another swing high here. And take a look at this. The swing high that's formed here is higher than the previous swing high. And the next swing high that's formed here is higher than the previous swing high. So as price continues to make new highs, the swing highs that's formed is always higher than the previous swing high. So when that happens, it's a solid uptrend. Okay. And similarly, for a downtrend, the same concept applies. We have a higher swing low here and another swing low here. And once this pulls back, we'll have another swing low here. And each swing low formed is higher than the previous swing low. Thereby, price keeps moving forward. As price keeps moving up, we will have higher high swing highs and higher swing lows. That is why we call this as an uptrend. Okay, it's fairly straightforward. It's just a naming convention, but you guys need to know what an uptrend is. Okay. Now, what is a downtrend? A downtrend is a bearish move where stock prices gradually declines over a period. An ideal downtrend is characterized by a series of lower swing highs and lower swing lows. Now, I was just talking about Tesla. Just take a look at Tesla's stock chart when it tested 500 a couple of days back. It's created a new high. If we just watch the stock chart, you can clearly see that the stock continued to fall down, decline, and then it created a lower swing high. And there were small retracement. Then that's where all the bulls got caught up. Hey, Tesla is going to rally now that it created. This is the support. We bought the dip. It's going to continue to rally. They probably bought the dip somewhere around here. Price did close a little bullish, but the next day it gapped down another 10%. And then they got caught on another swing. Got caught in another small retracement. They probably bought the dip here, got caught, and today Tesla was down 21%. So these kinds of things happen, and you need to know how to read what the primary trend is and what the retracement is, so that you can trade much better. So anyway, so back to the topic. So a downtrend is a bearish move, and it consists of lower swing highs and lower swing lows. So it is called lower swing high and lower swing low, because every swing high that's formed is lower than the previous swing high. So this was the first swing high. This is the second swing high, and the second swing high that's formed is lower. It's formed lower than the previous swing high. And similarly, bearish. The lower swing low that's formed over here is lower than the previous lower swing low. And as price continues to decline, every swing high that's formed and every swing low that's formed will be higher and lower than the previous swing high and low. Okay, that signifies a bearish move, bearish trend. And reading this is very important, especially I'll teach you guys when I open my stock chart, but when you see a big trend, so whichever move has, how do you identify which is the primary move and which is the retracement? So that's a common question that I always get asked. So you have to look at the chart on a bigger time frame. So if you continue to always look at the 5-minute chart on an intraday time frame, all these small retracement will look like a bullish move. Okay, but if you look at a longer time frame, like a 1-hour chart or a 4-hour chart or a daily chart, then you'll know that the bigger move is happening on the downside, and you'll be able to clearly tell that once the stock has created a high, if it continues to form a lower swing low and a lower swing high, that's a clear bearish move. You don't want to be betting against the trend. So what you could be doing is you could wait for the retracement and try to play puts or short the stock here. That's how you would make money. Okay, so that's a downtrend. I'll show you guys more examples later on, but hope you guys understood what a downtrend is. Now, the third type of trend is sideways trend. Now, contrary to popular belief, markets actually spend a lot of time trading sideways than they are in rally phase or decline phases. So it's actually surprising, 70% of the time, markets always trade in sideways ranges. So a sideways range is a period where the stocks trade in range without making any new highs or new lows. So take a look at this chart here. So we had a price was at $38 here in this top chart, and it was consolidating a little bit, and then it started creating a new high. Price rallied till 41, and then it started trading sideways. There's no more new swing highs or new swing lows. It's just trading sideways. It's just not moving. It's just trading between this 41 and 40.5 range for like from May 14th till July 14th. It was like trading in the side range. There's no value in trading the stock at all. It's just trading sideways. So when it's trading sideways like this without making any new highs or lows, common market terms, we will call this as a sideways trend, consolidation phase, showing indecisive trend. We'll call it many ways, but the guess is that the market's not making any new highs or lows, it's just staying flat. Okay. Now, when does a stock trade sideways? Stocks trade sideways when there's indecisiveness in the market. So this indecisiveness usually happens after a big impulse move or at the end of a trend. So in this case, on April 14th, the stock started to make new high. For the next 1 month, price rallied from 38 to 41, $3. It was not a strong move, but maybe the stock is a low cap stock. It made a $3 move this past month. So after a big move like that, stocks usually, before they start to rally even more, they need to consolidate for a little bit. So if this consolidation doesn't happen, stocks may actually pull back again to reach some kind of demand level and then take the new high up. So the fact that this stock didn't drop after this big move up, this shows that this stock is strong. And after consolidating for a while, what happened? The stock actually eventually broke out of this range and continued to make new highs. So as a trader, it is very important to avoid participating in the market when it is trading sideways. And this is more important as a day trader and as a options trader, because I'll teach you guys what when it comes to Greeks, what happens when price doesn't move in your favor. But let's say you enter a call position here and the stock's not moving anywhere over here. So if you just hold this play and you're looking for a long-term play or something like that, your premiums are just going to get burned because the stock's not moving high or low, and you're going to lose money staying in this trade. Now, as a trader, you can, instead of playing such a stock, you could just avoid it and move on to a different stock. Or what you can do is you can set your alerts at the higher end of this range, the lower end of this range, and wait for price to break out of this range and then play the stock. So in this case, price actually broke out of this range to the upside. So if you entered calls here, you bought the stock here, stock continued to make new highs and you would have made money. Okay, but if you had entered when it was consolidating here, you would have lost money. Okay. As a trader should wait for the market to break out of this consolidation range before entering the trade or select a stock that is showing a clear trend. Now, you don't have to play the stock. If this is trading sideways, there are a million stocks out there. You can choose something else that's showing clear trend and actually easy, good price action, and it's actually easy to trade. You don't have to always look for the complex stock that's not showing any trend. You may be able to make a money trading this one daily candle, some kind of breakout, but you don't have to do that. There are plenty of stocks out there that showing clear trend where you will have much more value for your money, easy, good risk reward, and you'll be able to make good money there. So it's up to you as a trader. If you wanna, but ideally you should be looking to play a stock that's showing clear trend. Okay, so that's a sideways trend. Hope you guys understood this. Now this example here. So I had the screenshot here. I added the screenshot to the slide because I wanted to show you guys how a general stock looks, any stock chart on the market looks. So generally in a longer time frame, you will notice that the stock's going up. So stock's low was set here and the stock's high is set here somewhere else, but the general direction of movement of the stock is up. But on an intraday basis, so what we've discussed, swing high, swing low, we discussed all these nice wave-like patterns. But on an intraday basis, the stock charts don't look that pretty. You won't get those perfect swing highs and swing lows because there's a lot of noise happening in the intraday charts, like 15-minute, 5-minute, even 1-hour charts. You'll have a lot of noise happening intraday. So if you're looking to play a trend bounce or something like that intraday, chances are you may get faked out. So that's why it's very important to look at a larger time frame too to get confirmation. So in this chart, if you look at a longer time frame, you'll be able to clearly tell that the trend is up. But if you look at a smaller time frame, you'll be able to observe a lot of noises. So in this case, there's an uptrend, then we have another downtrend. Look at this, we have swing highs and swing lows, and then lower swing highs and lower swing lows. And we have a sideways trend here where the market's consolidating a little bit. In this case, the market decided to break to the downside. So we broke this lower range and then found some support here and then started a solid uptrend. We broke this resistance here. That's why market continued to rally. And eventually we hit a resistance point here, started to consolidate a little bit and then started a downtrend and then market started to go up again. But the reason that I'm showing you is even though you're watching intraday timeframes, it's always good to get a confirmation on the larger timeframes. So in this case, the general direction of trend is bullish, but the market goes through several phases, that is uptrends, downtrends, and sideways trends. These movements can be observed in smaller timeframes more often. Okay? All right, now let's discuss something fun, trend lines. Trend lines are simply lines drawn on a chart connecting the swing highs and swing lows in a trending market. It is used by traders and technical analysts for trend identification and confirmation for their trade entries and exits. So how do you draw a trend line? We just discussed that it is just a line drawn on a chart connecting the swing highs and swing lows. So in an uptrend, the first thing that you need to do is you need to identify the swing highs and swing lows in a chart. Like I said, as soon as you look at the chart, you should be able to tell what the general direction of the trend is. So if you go to a 4-hour chart or a 1-hour chart, you should, just by looking at the chart, you should be able to tell that what the trend is. I mean, if the prices are moving up or down, or if they're consolidating in a sideways range. So in this example here, prices moving up. So how do you draw a trend line? In an uptrend line is drawn by connecting at least 2 or more swing low points. So in this case, the swing low point is here because price declines, finds support, then rallies. So this low point is called a swing low point. And over here, price creates a high. This is a swing high, and then it declines, finds support here. So this is a swing low 2, and then price continues to rally and creates a new low. So once I identify at least 2 points, I draw a trend line. Okay. And similarly, in a downtrend line is drawn by connecting at least 2 or more swing high points. So in this case, I've identified swing high 1 and swing high 2, and I just draw a line connecting those 2 points to form my trend line. So an important point here, this is the most important point. A trend line becomes active when price makes the third touch on that trend line. If the price breaks that trend line on the third touch, then the trend line becomes invalid. So what does that mean? So I have drawn my trend line by connecting 2 points here. Now let's assume that price actually approaches this trend line here, trying to form the third touch. Now, if price actually respects this trend line and bounces, then this is a valid trend line. This is a very active trend line. It becomes active, and you can actually use this to enter the play on. You can actually enter the bounce here and play the move to the upside, play the bounce. Now, if price actually does not respect this trend line and breaks on the third touch here, now this trend line becomes invalid. Okay, a trend line only becomes active on the third touch, and if it doesn't bounce, it's an invalid trend line. Okay, now you will have a lot of valid trend line and a lot of touches on longer time frames. So now if you're taking a daily time frame or a 4-hour time frame and you see a lot of touches, if you're able to identify a lot of swing low points and connect those swing low points, that will be a trend line that's more powerful even on an intraday basis. So if you see price approaching the long-term trend line, long time frame trend line, and you can bet that 9 times out of 10 there's going to be a bounce. Okay, so that's because price has been testing that trend line for a long time, and chances are we're going to get a bounce again at that point. Okay, so I also get another question always. The trend line is drawn in an area where you can find the most touches. So doesn't matter if it's the wick or the body of the candle, as long as you can connect, as long as you can find the area where you can find the most touches, you can just draw a trend line there. Again, it depends on the trader, but this is how I draw it. I just look for the most touches. I don't care if it's the wick of the candle or the body of the candle. It would be great if you can connect the wicks. But if one of the candles is just showing a body, doesn't matter. It's just showing that the price actually respected that trend line and actually closed like very, very strong. It's a whole range candle. So it just shows that it's a very strong candle there. It doesn't matter if it's the wick or the body. Find the most touches, then draw the trend line. Okay, I hope that this concept's clear. So just to summarize, so an uptrend line, you find the first step you need to do is you find the swing lows. So in a trend and an uptrend, once you find at least 2 swing lows, you would draw a trend line across it, and the trend line becomes active on the third touch. If price actually respects this trend line on the third touch, then it's an active trend line. If it doesn't and it just breaks through, then it's an inactive trend line. It becomes invalid. You probably have to look for something stronger, or you can play the downside move. Okay. Now, as a trader, why do we draw trend lines? Trend lines can act as a form of support and resistance and help traders plan their entries ahead of time based on price action. So Mike just went over support and resistances, and trend lines form the same kind of help you form the same kind of support and resistances. And if you take a look at this chart here, the swing low points acts as a support here. Here we have 3 touches of support, and swing high points here have 3 touches of resistance. Now, price breaks either side of this trend line, there's a good trading opportunity here. And if price respects this trend line, you can buy calls here and just ride the trend. And similarly, in the downtrend, the same thing. The swing low points acts as support, and swing high points acts as resistance. And as long as price respects this trend line, you have a lot of trading opportunities. If it breaks, you have a reversal trade there. Okay, that's one reason why we draw a trend line. The other reason is a break of a trend line is a sign for potential reversal in the stock. Now look at this example here. So we have 1 touch here, 2 touch, and 3 touches. So this is a strong trend line. Now, if you're a trader and you entered puts here at the 3rd touch here, you had a nice downtrend move here. This was the swing, a lower swing high, and you had a move to the lower swing low. Now, once price started to reverse, you could have taken profit here, but if you didn't, you could have exited your trade here once the trend line was broken and just switched to calls after that or buy stocks after that. So you can clearly see that once the trend line is broken, it gives you, as a trader, it gives you a stock, it gives you a chance to enter the reversal side of the trade. So if you were in puts, you could enter calls. And if you were in calls, you could enter puts if the uptrend breaks. Okay, so these are all strong trend lines. You have 3 touches here, price bounced, but eventually no trend lasts forever. So that's a common thing. Stocks continue to keep going up. At some point, that trend line is going to break. And when that happens, that's a chance for you to make money, because price action is going to be strong once that long-term trend is broken, and that's going to give you an active trading opportunity. So Break of trend line is a sign for potential reversal in the stock. Traders can capitalize on break of trends to either exit their current position or take a new position, long or short, based on the direction of new trend. Long meaning you can play the upside move once this downtrend is breaks. Short meaning you can play the downside move once this uptrend breaks. Okay. To summarize, we draw trend lines because they are very useful for trend trading, that is trading along the trend, and reversal trading, trading on the break of the trend. Okay. Now, before I discuss this, I hope that you guys understood what swing highs and swing lows are, how to draw a trend line, and the three different types of trends: the uptrend, downtrend, and the sideways trend. So ideally, once you go through this lesson again, when you open your stock chart, you should be looking at for the first thing you should be noticing is what the primary trend of that chart is, and then you need to see what the swing highs are, swing lows are, and then try to find if you can find any trading opportunities there. Okay. So how to use trend lines and select a time frame for trend trading. Trend lines can be placed on any time frame, but they're generally more effective on longer time frames, like I said. So there are three types: short-term trends. Short-term trends last anywhere between several hours to several days. Intermediate term trends that last anywhere between 10 days to a few months. And then long-term trends, which last anywhere between several months to several years. Okay, so I'm going to explain my process here right now. So step one, as a day/swing trader, I'm interested in short and intermediate term trends. So I'm interested in trends that last between hours to several months. So I start with a daily time frame and then draw my trend lines by identifying the swing highs and swing low of the dominant trend. So I open my stock chart, whichever chart it is that I'm interested in, go to the daily time frame. Just by looking at it, I'm just going to know the stock price is continuing to make new highs. That is, if it's in an uptrend or a downtrend. Once I know that, I'm going to look at the chart to identify the swing highs and swing low points. Once I do that, I'm going to draw my trend line. Okay, first on the daily time frame. So ideally, what I do is I use different colors. So in a daily time frame, if I draw a trend line, I maintain one color. And if I decided to draw an intraday time trend line, I use a different color. So that way I know which trend line is stronger. If it's a daily trend line, I know that that's going to be respected more in an intraday basis than that of an intraday trend line. Okay. So first step is I draw that daily trend line. And once the dominant trend is established, smaller short-term trends can form within. I use the 4-hour, 1-hour, 15 and 5-minute charts to analyze and trade these short-term trends in an intraday basis. Now, I already mentioned this. Smaller time frames normally contain a lots of noise leading to fakeouts. So even if you prefer to execute your trades on a smaller time frame, it is always better to use longer time frames for confirmation, especially if you're drawing a trend line on a 15-minute chart. And so stock may have and going back to the Tesla example again, Tesla just had a big sell-off on a 15-minute time frame. After that support was formed, stock may have been creating a swing high and swing low. You may be drawing a 15-minute trend line here, and you think that this is going to keep going up. Now you may get in and you may day trade that buying the dip opportunity, and you can day trade and make money off of that. But if you're going to hold the play overnight, or you're thinking of something long term, then obviously you need to look at long-term time charts for confirmation. If you look at a long-term time charts, you may change your bias. That small rally, 15-minute chart rally, may look like a small retracement in a longer time frame, and there may be potentially more room to the downside before the stock actually decides to change trend. So if you're looking to hold plays overnight, or taking a long position on a stock, or a big short position on the stock, always look at the longer time frames. And even though you may execute your trades on a shorter time frame, always look at the longer time frames for confirmation. This is very important. This is very fundamental and basic. Even a lot of medium-sized traders, people who've been trading for 6-7 months, sometimes they don't do this and they end up losing money. So it's very important that you start looking at longer time frames from the get-go when you start trading, so that you can avoid losing all the money and then learn from your mistakes. So let's just avoid that step and start looking at longer time frames. Okay, that's step one. Step two, finding areas of confluence for entries and exits. You should never enter a trade just because you think price will react in a certain way at the trend line. Price can always break or reject the trend line. You should always wait for price action at areas of confluence before entering a trade. Now let's go back to this example here. So we have this nice uptrend line, active uptrend line here. We had one touch here, two touch, and three touches. So if you wanted to take this stock long and you wanted to take the break touch of this trend line, and you think that the stock's going to just continue to bounce here because this is a solid trend line, if you took the trade prematurely before watching price action at this trend line, you may have been stopped out here once the trend line broke. So it's always important that you wait for price action at the area of confluence. In this case, is a trend line and a combination of some other indicator. If you don't watch price action here and just enter the trade prematurely, you're going to get stopped out and lose money. So always need to watch price action at these key areas, and based on price action, you enter the trade. If the price actually bounced off of this trend line, then you can enter the play. But if price breaks, you should play the downside or just avoid the setup. Okay, so it's always important. You shouldn't enter a trade just because you think something's going to happen at some place. You have to always watch price action. It's the same for any kind of support resistance area, indicators, or any theory or analysis or strategy. You always wait for price action to be confirmed before you're entering a trade. You don't enter because you think price is going to bounce there. You actually wait for price to come to that point, see if it bounces there, and then take the trade. Okay? Because you're not going to lose that opportunity. That opportunity is going to be there. And if you lose the opportunity, that's fine. There's always going to be another trade. It's always important to wait for price action. All right? So what is this area of confluence? I mentioned that in a couple of different places. So what is area of confluence? Area of confluence is the intersection of key levels in a chart. So the first thing that we're going to draw a key level is a trend line. So we just discussed trend line. And we also know how to plot support and resistances. Mike just covered that. And we'll also be going over many different topics in the future on how you can actually plot support and resistance. And we're going to be having moving averages, so which is another technical indicator. We're going to be covering Fibonacci retracement levels, which is another form of support and resistances in a chart. Now, when you see a lot of intersection of key levels, meaning you see a trend line, you also have a support and resistances in the same area, then chances are price is going to actually be strong in that area. Price action is going to respect that area, and it's either going to bounce or there's going to be a big decline. So such an area in a chart is what we call as area of confluence, because there's just not one area, just one line of support there. There are multiple elements in the chart that's just intersecting at that same point. And something like that, if you're able to find an area like that in the chart, price action is going to be strong. You're going to see strong volume, and that's an area where you should be looking to enter or exit your trade. So once you identify an area of confluence, you can establish entry, exit, and stop loss levels. So it should be based on the daily, 4-hour, 1-hour, 5, and 15 and 5. And I'll show you guys how you can form the area of confluence in the next slide when I go over the example. So to summarize, your trade entry needs to be based on price action at areas of confluence. Check if there's good volume at this area of confluence. Trading activity should increase at areas of confluence. So this point here is important. So when you see a stock rallying and just moving along, at some point there will be a breakout, or there's going to be an area where there's going to be a lot of price action. So what does that mean? So that's what we call as an area of confluence, because at that area, wherever that key intersection area of a chart, we're going to see a lot of volume coming in. What does that mean? Volume is just a record of the total number of transactions, both buys and sells. All transactions that's happened in that period is going to be recorded as volume. So if there's 100 transactions, it's going to be recorded as 100 volume. 1,000 is going to be recorded there. So whatever the case is, at that area of confluence, you're going to see a lot of volume coming in. When there's a lot of volume coming in, that just means that a lot of people are interested in the stock at that area of confluence. So typically when a lot of volume comes in and the bulls and bears are fighting it out for control at that key area of confluence, one of them is going to win. The bulls win, there we're going to see a bounce at that trend line area and stock price is going to push up. But if the bears win, then the bears are going to take control and push prices down and we're going to see a pullback. So it depends, as long as you have your area of confluence plotted right in your chart, you'll know when price is going to break, like respect that area or just going to break that level and move down. And based on whichever direction it breaks, you have to take the trade in that direction. And another thing that you can do is you need to always use multiple time frames to confirm your directional bias. Longer time frame trends are stronger than short-term time frame trends. That's where you have your more value for money. Because long-term time frame trends are stronger. So if you have a short-term retracement, that may last only for a few hours, but then the long-term time frame is going to take over and control the dominant trend. Relying on multiple confirmation, that is using your multiple areas of confluence, see good volume, and also verify multiple time frames. Relying on all these multiple confirmation increases the probability of the setup that you're going to take. And it also helps you avoid fakeouts, especially when trading on a smaller time frame. Okay, I hope that this summary was useful. Now I'm just going to jump to the examples. So the first example that I'm going to show you is actually a trade that we took in the stock chat. So earlier this year, February, I signaled, I posted a play, just a simple trendline play. I said that Peloton, PTON, that's a stock, break below 33.25 for puts. So what does that mean? I was saying that watch Peloton below 33.25. If it breaks below that level, then I'm going to buy puts. The target for this play, the first target is 32.85, second one is 32.45, and third target is 31.9, meaning I'm having 3 profit targets here based on price action at these key levels here. The price action is actually still weak. I'm going to hold it to the next target. But if price is actually strong here and bulls are trying to buy the dip, then I'm going to just take profit here. So I set 3 targets for this trade. Now, I also had a bullish bias because this is a trend line. I don't want to just say that the trend line is going to break. So if the trend line actually was respected and it breaks above the 34.6 level with volume, I'm getting calls. Okay. So Peloton also had earnings the next day. So I said that I'm going to play puts if I'm going to play it. Right. So this is the trade. I actually made like, I can't see this number here. I think it's $555. It's like 70 or 80% return on this trade. Okay, so I made that much. Now let's take a look at this chart here. In fact, let me just jump to TradingView after I review this example as well. Okay, instead of storing the chart, you guys, if you want to take a screenshot, you can of this. Because I'm going to go to my TradingView, it may not be that clear. So if you guys want to take a screenshot of this, I'll wait for a couple of seconds. Okay. So the second trade that I took, so in our last class, our previous batch, I was actually presenting the same example, and I told them that I'm going to take Peloton long the next day on 8/11. I posted this trade on Instagram and our stock chat. So I said that I'm going to take Peloton long at 64 because I expect a bounce there. And look what happened. So I posted this in StockTwits too. Once we had that bounce, Peloton actually rallied 37% in a span of 2 weeks. This is a long-term trend line. Peloton actually bounced and made a rally of 37.43%. Okay. Now let's just see how I'm going to share my TradingView now and show you guys how to draw all of this. Okay. All right. Can you guys see my TradingView? Let me see if I can get the chat open so that I can see the questions. Okay. Anyway, all right. So as long as you guys can see my TradingView, I'm just going to get started. So Peloton IPO'd October of 2019 and didn't have much of a data here. So I had to draw a downtrend because ever since its IPO price, it had a downtrend. And these green lines you see here are actually support and resistance lines that I've drawn. So Peloton had a downtrend. It was trading choppily. Then once it had this enough range, it actually broke this resistance that was created and started trading in an uptrend here. So the way I've drawn this uptrend line, you can clearly see that I've connected the place with the most touches. So we have 1, 2, 3, 4, 5, 6, 7, and 8. So once we've had, I'm currently in the daily time frame. So once I found all these common areas of touches, I drew this trend line. And so see what happened at this area of confluence here. So we had a break of this trend line. Look at the volume here at this break. So price clearly broke this trend line, created a new low. It tried to reclaim this trend line, tried to again break above this trend line. It couldn't, got rejected again, and like fell to a new support. The stock was consolidating here in a sideways trend without creating new highs or lows for a while. And then it started a new downtrend, small pullback. So if I actually, to make things more visual for you guys, I'm going to change this candlesticks chart to a line chart now. So take a look at this. So price created a new high. This is a pullback, created a new high. Then it started a new downtrend here. This is a lower swing high, lower swing low, lower swing high, lower swing low, lower swing high, and another lower swing low. Okay. So once we've identified this downtrend, price actually started to trade in this channel. So we actually have a small rally here. Price is actually trading sideways, but ever since December of 26th until February, so that's like a solid 2-month period, price was actually making highs and lows and was trading in this channel here in a small uptrend here. Now I'm going to jump to the 4-hour time chart because that's my favorite time frame. 4-hour and 1-hour is my favorite time frame always. The reason I choose the 4-hour and 1-hour because I have more data to work with. So if I just go to the daily time frame, each candle is just representing one day. I don't have a lot of data. I can't see where price action was strong, where price action was weak. But if I jump to the 4-hour and 1-hour time frame, I get more candles and I can see what actually happened at key areas. So in this case, so once this downtrend was established, price was trading in this channel here. And this is where I actually signaled the play. So this was actually a 2-month trend. So ever since December to February, we've been trading in this tight channel. So we have 1 touch, 2 touch, 3 touches here. The same way, 1 touch, 2 touch, and 3 touches. And the 4th touch here. So what I was expecting here is I had a very bearish bias on Peloton because at that time it was very overvalued. They weren't making much money. It was just a new IPO and they were already trading at a market cap of a crazy amount. So I had a bearish outlook on the stock leading to earnings. So I wanted to play the downside because I was strongly, since this trend line was respected for the past 2.5 months, I had a bearish view on Peloton. So that's why I first said that I'm going to enter puts below 33.25. So you may ask me, how did I get this 33.25? So if you look at all these lines that I've plotted, these are key areas of support and resistances in the chart. So price actually, over here, let's start from here itself. So price actually rallied, set this new high, continued to decline, then it struggled to break this new high here again. And once it broke, we had a rally, continued to decline here. We found some support here, so that's why we have this green line drawn here. We have multiple rejections at this area, then we have support here, resistance turns of support here at this area. So you guys get the points. And once this level was broken, we actually had a big decline here again, and then we find support here. So let me actually zoom this a little bit so that you guys can see. At this area here, this point here was my entry for the play. So this blue line that you see is 33.25. I said I would enter puts here. Now look at this area here. So we had 1 touch, 2 touch, then we had some chop here, 3 touches. This was a support. This was a support here, and this support was broken. That's why when we had this big candle, look at the volume at this candle. So it shows that this area, this support level was very strong. And then we had a decline. Price tried to break above this level, but got rejected. Look at this wicks here. This wick shows that there was strong selling at this area, and look at the volume here again. So that shows that this is a strong level. And coming again to January, again, price tried to break this level, strong rejection. Price tried to break this level, strong rejection again. So it shows that it's a very strong level. And the previous day, that is on February the 4th, price actually broke this level here and decided to test this upper end of this trend line. So my position was, if we reject here at this trend line, I'm not going to enter the puts here at this trend line because price can always retrace back and then shoot up again. I want to look for area of confluence. So in this case, the area of confluence was this support level here. So I waited for price to break this level, test this trend line, and once the break of this support level, this blue line here, that's when I would enter the trade. Okay. So but now I'm going to jump to let's say 1 hour chart. Okay, seeing a lot more candles here now. See what happened. So the first time we actually tested this trend line. So if I actually entered puts just at this trend line, I would have made money, but see what happened. The price actually was choppy. It actually like quickly bounced up and actually retested that trend line, upper end of this trend line again. It couldn't break it, but once it couldn't break it, look at that's where we had the rejection candle and we had a strong down move here. That's when the selling started. And once we actually broke this level, this blue line, we had this big candle here, and look at the volume at that candle. So that's our confirmation. It was been trading flat all day. Then once we broke this level, we had our trade triggered, entry level triggered, and we took the trade. This was T1, which was 32.90. This was T2, and this was T3. Price actually went a little bit below T3, but we took profit right at T3. It was 31.9. But you can clearly see what happened at this level. There was a big bounce of the stock. Then once this bounce happened, there wasn't bullish momentum at all. Remember, I told you that once this big move happened, the trend was starting to look weak. There would have been a more downside move ahead. Price started to consolidate, and this was actually the retracement that we had, the strong bounce. So this was the swing high, the swing low, lower swing high, and the next one is lower swing low. And Peloton actually gapped down pretty big after earnings. So this is what happened after earnings. They closed at 32.6 and they actually dropped to 26. So there was a big gap down for Peloton the next couple of days. Then the stock consolidated. Let me move on to the 4-hour chart again. I'll teach you guys how to find these entry and target levels in a future lesson. I have a separate section in the course to teach you guys how to do that. But you guys understood the basics, right? Looking for areas of confluence and enter the trade, and then trying to follow the trading plan and take profit at these key levels. So it's a perfectly executed trade. And so moving on. So once this downtrend was broken, so price actually, people might have bought this dip again. This is what I was telling you guys, but the dominant trend is bearish. So we actually switch back to a line chart here again. Clearly see what happens. So price bottoms, has a small retracement, bottoms again, has a small retracement, then like trades a little in ranges, and then has this big drop, has a pullback, then it starts to create a new uptrend. You can clearly see how the uptrend acts, right? So this was a resistance. Once this level was broken, we have been trading in an uptrend. So if price actually got rejected here, then there was another downtrend leg coming on. Okay, so now let me switch back to the candle chart. So that was the first trade. And the second trade that I posted, so just to read through Peloton. So once we broke this uptrend, we had a little consolidation here and another actually consolidation here in this period. But Peloton has been on a tear ever since it broke this previous all-time high resistance. So there was the all-time high resistance. Once we broke that level, it's been on a great tear. So this was the long-term trend that I was talking about. So Peloton was respecting this trend ever since April 30th. And what I was telling those guys was that when I posted the play in the chat, so we had another small channel here. So Peloton was respecting this channel here again. And this blue line is our area of confluence. So I told everyone that just buy the dip at 64, and on August 11th, you can clearly see the area of confluence here. Look at this green bar here, this green volume bar. We had a strong price action. Once the stock gapped down, we test the lower end of this trend line, and the price actually bounced hard. It was a little choppy the next day, but if you actually went long here, eventually we tested the upper end of this trend line, and actually we broke the upper end of this trend line on the third touch here, and then created new highs. So it was a 37% move in just a span of 1.5 weeks for Peloton. It's a little, it's consolidating here. It just ran too fast. It's consolidating here, and it has earnings tomorrow, so anything can happen. But you guys see how easy it is to just use trend lines and the basic support and resistances to make plays. If you know how to read a stock chart that is identify swing highs and lows, draw your trend lines, draw your areas of support and resistances, find areas of confluence, set your targets, and simply just take the trade, you're going to make money. You don't have to complicate anything. There are no indicators here, no nothing. Just reading simple stock chart, just setting your levels up, plotting your trend lines, and then taking the trade. Now, and I'm on a longer time frame, but you guys get the point. If you buy 2 weeks out contracts here, that's a big win for you guys. And if you guys continue, if you just took a trade every time it touched this bounce here at price action, you would have made money. As long as you study the stock chart properly, there are going to be plenty of trading opportunities for you guys to make money. It's not that hard. Keep it simple, and you guys will make money. Okay, so I hope that you guys learned a lot from this lesson. It's a little basic, but it's a very important introduction that all of you should be aware of. Thank you guys. Now it's time for questions.
How's it going? Make sure you guys leave a testimonial in the Discord group chat.
You guys have any questions for the class today? Miami's nice.
Yeah, Miami's nice. What constitutes good volume? We'll be going over that in the later classes.
As a beginner, when would be the best time to start trading? In the morning?
He said in the morning.
Draw
The best time to start trading would be honestly right after this AMU class.
Oh, I thought he meant like what time of the day.
Oh, okay.
Yeah, about the trend line question. If you guys have long-term trend lines, you can just keep it on your chart. Just use different colors. That's what I do. I don't usually draw intraday trend lines because they're not strong. They have a lot of noise, so I won't have that in my chart.
Yeah, you can draw those trends on Thinkorswim as well. I just like the charts better on TradingView.
Yeah, I always have my chart saved, so I always have levels plotted in my chart. If something's changing, then I remove them, but other than that, all my charts are saved. So I have something always on in my charts. Just a priority.
Why does R enter trades 15 cents above the highs and the lows? Because that's just the entry point. There's no, you know what I'm saying, rocket science to it. Is it on daily time frame?
I use the 5 minute for scalping.
Do you enter trades from market orders? I do. How long you said wait to after a break? Support resistance, enter a trade, 15 cents. The answer gonna continue to be 15 cents.
There is a free version of TradingView, but it's really bad. I mean, at least get the pro plan, which is only like $15 a month, something like that.
Will you teach scalping method? Yes, I will.
Yeah, you can create an alert on any stock.
Intraday, that just means trading like literally when the market's open and buying and selling the same day.
Can these same things be applied to Forex? I mean,